Next, we are going to be talking about momentum, or if you want to know the real fancy term for it, serial autocorrelation. And so this was one of my favorite topics to teach, as this was my first academic paper that I wrote as a PhD student. And wouldn't you know it, that it's actually the most downloaded paper that I've written, even all these years later. Lucky first punch, but it's still a very cool topic to talk about. And this is number 4, where we're talking about momentum. And somebody asked me after all of that if I knew what serial autocorrelation was. And I told them I didn't know, but then I realized they're the same thing. So I guess I do know. It's so serial autocorrelation, fancy term. So what this looks like here is we're going to, at very high level, we're going to take the stocks that have performed well in the recent past, and we're going to buy them and we're going to hold them for a short amount of time. And when I mean that, we're going to look at the recent past between 3 and 12 months. And then we're going to take those winners, the ones that have done really well, we're going to buy them. We're going to hold them for another 3 to 12 months and then sell them. And what happens here is the momentum. Even if we buy high after it's made a run, we're going to sell higher, making a profit off of this. So we see that on the momentum side positively. And then we also see a similar dynamic, not as strong, but the same idea is if there is a bad performing stock over the last 3 to 12 months, we're going to try to sell that short if we can in our portfolio and then let it continue to slip and then buy it back at a lower price. So that's the idea around this. And let's get some formalization around this, that high performing stocks, and like we said, this is the past 3 to 12 months, outperform low performing stocks. And once again, even after factoring risk, and this is, we're going to hold these for 6 to 12 months typically. And so once again, if all information is available for all stocks, everyone knows public information, just going back and checking the previous performance should not give us any sort of insight onto which one will perform better than the other. And so this is once again a challenge of semi strong and even weak, where we're just looking at previous returns and still finding that we have ways to outperform the market. So what we do here, if we want to set this up, we can stack up just like we did with the other value and growth stocks, and same thing with the small and large cap stocks. So we're going to take all the stocks that we're analyzing. So let's just keep it simple. Let's say we have 30 stocks from the Dow components, Dow 30. And we're going to take the past performance of, we're going to say 6 to 12 months. And this is what we call our formation period. And we're going to list all the performance in order from highest, best to worst. And once again, we can slice it in whichever way we want. But if we want to keep this simple, I want the best 10%, and then we'll have the worst 10% performers. The best 10% performers, we're going to call this the winning portfolio or the winner portfolio. And then the top or the bottom 10%, those are the losers or the losing portfolio of the last 6 to 12 months. So what we do here is we will buy these three stocks. So 10% of 30, buy the three stocks, buy. And if we have the possibility, we can actually sell, short sell. But what's really interesting, and this was the paper that I wrote about this, is we said, hey, most personal investors, myself included, we don't have the capabilities of selling short. We have a lot of constraints. There's margin calls. There's all sorts of different frictions that go in with selling short. So we propose that, hey, let's just do the buy side and just go long these because we could all do that. And we found really high returns that really outpaced even the S&P 500. So anyway, let's follow this. Here's our trading day where we buy the three best, we short sell the three worst. And we are going to hold, this is our holding period, another 6 to 12 months. And then after the 6 to 12 months holding period, and we have this open window because we found in literature and in the past that regardless of whether it's 6 or 12 months, we still find these positive returns. So we'll leave it up to you how long you want to hold it for. But then at the end of that holding period, we are going to sell those stock positions and we're going to buy back our short positions. And because we're going to do an equal amount of each of these stocks, so if you have $30,000, I'm buying 10,000 of each. In theory, what you could do is sell short $10,000 worth of each and then use that money to buy it. But like I said, there's some friction that don't really work in that favor. But then when you sell, the way you can actually compute your returns, and we'll just use the top side here, is if stock number one earns 10%, stock number two, 20%, and stock number three is 30%. You take the average of these three, and we see here's 20%. And we'll compare it against the market at the same time, including our volatility or our beta risk. And we can run that calculation that we did in a couple of videos before to see if we can generate alpha. And what we found here is in previous literature that you can generate pretty significantly high alpha over time. And so the first paper that I wrote was initially looking to see that it didn't exist, but then we found strong evidence that it did. And so follow up to that was writing another paper that was piggybacking on that first one, and then found out that these momentum returns recently have gone away. So it means that just because something has worked in the past does not mean it'll work in the future, especially if something becomes more widely known or widely used. Then a lot of these mispricings will often go away. But anyway, this is how you would set it up. Buy the winners, sell the losers, and then close out within 6 to 12 months. So that is our momentum trade. And when we come back, we are going to reverse the order and use a contrarian strategy. So we'll see you on that next video.